Hey everyone, welcome back. Ready for another deep dive.
Always ready. What are we digging into today?
Today we're tackling the world of technical analysis.
Oh, interesting.
Yeah, trying to figure out what the markets are trying to tell us through all those charts and signals.
Sounds complex.
It can be, but we've got a great source, a really practical guide to help us break it all down. And the best part is you don't need a PhD in finance to understand it.
That's good to hear.
We're going to be talking about things like overbought versus oversold signals,
Mm.
moving averages. Can they really help predict where prices are headed?
Mm.
And even something called Fibonacci.
Fibonacci, like the art thing.
Exactly. But turns out it's not just about art. It's a big deal in finance, too.
Well, now I'm really curious.
The whole idea of this deep dive is to give you the tools to make more informed investment decisions. We're not promising you'll get rich quick, but you'll definitely understand those market signals better.
I like that. Knowledge is power, right?
Absolutely. So let's start with something that's always been a bit of a head-scratcher for me, RSI.
Ah, yes. The relative strength index.
Can you, demystify it for us?
Mm.
What is it really, and why is it so important for investors to understand?
Sure. So think of RSI as kind of like a thermometer for investor sentiment.
Thermometer.
Yeah, it measures the heat of the market. It's on a scale of 0 to 100.
Okay.
Now, when that RSI starts climbing up towards 70 or even higher, that's like the thermometer going into the red zone. It's a warning sign that things might be getting a little overheated.
Overheated, how so?
It could mean that the asset is overbought. Everyone's jumping on the bandwagon, maybe driven by FOMO, and they might be ignoring the fundamentals.
So it's like a gauge of how much fear and greed is driving the market at that
Shape
moment.
like that.
So if the RSI is high, it might be time to take a step back and assess things before jumping in.
Yeah, exactly. I mean, it doesn't necessarily mean the price is going to drop immediately,
Right.
but it's definitely a signal to be cautious.
And what about the other end of the scale? When the RSI dips below 30?
Well, that could signal an oversold situation. Basically, it means that the asset might be undervalued.
So it might be a good time to, look for bargains.
It could be. It's kind of like finding a hidden gem that everyone else has overlooked. But again, it's important to look at other factors as well.
Now, you mentioned other factors. Our source also talks about divergences.
Yeah, divergences.
And I've always found them a bit tricky. Can you give us an example of what a divergence might look like, and why should we even care about them?
So a divergence happens when the price of an asset and the RSI are telling different stories. Let's say a stock price is going up. It's making higher highs, looks great on the chart.
Right, looks like a winner.
But at the same time, the RSI is actually making lower highs.
So it's like a secret message hidden within the chart.
Kinda, yeah. It's like a warning sign that the upward momentum might be weakening.
So even though the price is still rising, the RSI is saying, hold on, there might be trouble ahead.
Exactly. That divergence could signal a potential trend reversal.
So it's like a heads up from the RSI, saying, hey, things might not be what they seem on the surface.
That's a great way to put it. And to really get confirmation, you can look at support and resistance levels.
Support and resistance.
Yeah.
They're like the floors and ceilings of price action, right?
Precisely. They show those key points where trends have historically reversed. Combining them with divergences can give you a stronger signal.
So it's like having multiple pieces of evidence to back up your investment decisions.
Absolutely. Now, speaking of signals, let's talk about MACD.
Yeah, MACD. I used to be completely intimidated by it, but now I see how useful it can be, especially for timing entries and exits in trades. It compares the short-term and long-term moving averages, right?
You got it. It's like looking at the market's short-term mood alongside its long-term trend.
So how do those moving averages help us?
Well, when the short-term moving average crosses above the long-term one, it often signals a potential buying opportunity.
Oh, I see. And if the short-term dips below the long-term, that could signal a sell.
You got it.
Now, there's also that histogram thing that's part of NCD. It always seemed a bit, mysterious to me.
Well, the histogram is a visual representation of the difference between those two moving averages. It basically shows you the strength of the trend.
So how do we read the histogram?
It's pretty straightforward. Taller bars, stronger momentum, shrinking bars. Momentum is fading.
So it's like a volume control for the trend, showing how much power is behind the move.
Exactly.
But even with all these fancy indicators, We can't forget about plain old volume, right?
Right. High volume during a price move is like a big flashing neon sign that says, pay attention, this is the real deal. It confirms the conviction behind the move.
And low volume.
Low volume can make you question the sustainability of the trend. It's like, is anyone really behind this move?
Now, let's talk about something that seems almost too cool to be true. Fibonacci retracement. It uses this mathematical sequence to identify potential price corrections. It's always seemed a bit, well, mystical to me. How does it actually work in the real world of trading?
Honestly, it's pretty practical. You see, markets often retrace a portion of a previous move before continuing in the original direction, almost like taking a breather.
Okay.
Fibonacci levels act like guideposts. They pinpoint potential support and resistance points during those retracements.
So it's like predicting where the market might pause for a break before continuing on its journey.
Exactly.
And what about Bollinger Bands? How do those help us?
Bollinger Bands help us see how volatile or calm the market is.
Okay.
So when the bands widen, it means volatility is increasing. Things are getting a bit wild and unpredictable, maybe riskier too.
And when they narrow?
When they contract, it suggests things are calming down.
So it's like they're giving us a visual cue about the market's mood swings.
You could say that.
Before we get too excited about all these tools and start making trades, we have to remember what our source says about risk management.
Oh, absolutely.
It's easy to get caught up in the charts, but what are some practical things investors can do to stay grounded and manage risk, especially when using technical analysis?
Well, first off, no technical indicator is perfect. They give you insights, not guarantees.
Right.
So don't rely on just one indicator. Combine technical analysis with fundamental analysis.
Meaning?
Look beyond the charts. Understand the company's financials, the overall market
It's
conditions.
about getting the full picture.
Exactly.
Yeah.
And possibly the most important thing is managing your emotions.
Oh, that's huge.
Because fear and greed can really cloud your judgment.
They can. Our source specifically mentions stop-loss orders.
Yes, stop-loss orders, essential for risk management.
Can you remind us how those work?
Basically, you set a predetermined price at which you automatically sell an asset if it drops.
So if the market moves against you, the stop-loss helps limit your losses.
Exactly. And just as important, it helps you avoid making those impulsive emotional decisions.
So it's about taking the emotion out of trading.
As much as possible.
Well, we've covered a lot today, from deciphering RSI to understanding how volume plays a role, to even diving into those slightly mystical Fibonacci levels.
It's been quite a journey.
It has. But now that you've got all these tools in your arsenal, which ones are you most excited about? How are you thinking about using them in your own investing?
That's the million-dollar question, isn't it? There's so much information available these days, it's easy to feel overwhelmed.
Definitely.
The key is to find the indicators that work for you. Don't try to use everything at once.
Pick and choose your weapons.
Right. Experiment. See what fits your style and risk tolerance. Learn to trust your gut. Combine it with the insights from these tools. And remember, investing is a marathon, not a sprint.
Some great advice to wrap things up. Thanks for joining us on this deep dive into technical analysis. We'll see you next time.